everyone, in today's lesson we'll be talking about the classifications of accounting. And when I talk about the classification of accounting, I'm referring to the subfield of accounting or its branches. So there are three major branches of accounting, and it includes 1. Financial accounting, 2. Cost accounting, 3. Management accounting. And in this lesson, we'll be talking about these three major branches of accounting. So let's begin. 1. Financial accounting. Financial accounting is a branch of accounting which focuses on recording, classifying, and summarizing business transactions in a standardized financial statement, such as the income statement, balance sheet, and the cash flow statement. The purpose of financial accounting is to provide a picture of entities' health and performance evaluation for its external stakeholders. So basically, it's to give the stakeholders an idea of what is actually going on in the entity, how their money is being spent, and the returns they are making. Usually, financial accounting adheres to strict accounting guidelines and rules, and it might be the generally accepted accounting principles, that is the GAAP, you might have heard of it, or the International Financial Reporting Standard, IFRS. This set of accounting standards and guidelines are usually adhered to in order to ensure that the accounting information made available to the general public are reliable, relevant, and comparable. So, the importance of the accounting standards are majorly these three things: to ensure reliability, relevance, and comparability. Reliability, it means that the information given out are truthful, so there are evidence backing these transactions. Then relevant, it is actually what the stakeholders need. So to ensure that the entities are providing them with information that are actually useful. Then comparability, this is to ensure that the accounting information provided can be compared with that of other organizations. So if I'm going to invest in company A, I can take its financial statement and compare with that of company B to give me an idea of the best investing decision to make. Then we have cost accounting. Cost accounting is a branch of accounting that majorly focuses on the monetary transaction of an entity. It's majorly focused on the expenses. So cost accounting involves recording, analyzing, and reporting of companies' expenses in details. It focuses on the monetary value that has been utilized by an entity in production of a commodity. So it focuses on the actual cost of production. It focuses on an entity's expenses, what they have spent, what the entity utilizes in the production of cost of goods and services. So the benefit or the main purpose of the cost accounting is to track all of a company's expenses to enable better decision making. So since cost accounting focuses on cost, we are going to be explaining some of the elements of cost. And for the elements of cost, we have the direct material. So these are the materials, these are the raw materials that are transformed into finished goods. Then we have the direct labor. Direct labor, these are the wages that are paid to workers who are physically involved in transforming those raw materials that were purchased into finished products. Then we have other overhead expenses. So other overhead expenses include cost of utilities, factory rent, depreciation. So like these are other costs that go into the production of those products. Finally, we are going to be talking about the management accounts. The management accounts, usually known as managerial accounting. This is a branch of accounting which focuses on the use of both financial and cost accounting information to provide management with a better tool for decision making. So the management account focuses on management, the management of the entity. It focuses on helping management make proper decision, more strategic decision. So it is internally focused. It is the process of identifying, measuring, analyzing, interpreting, and communicating financial and non financial information to managers for the purpose of planning, cost control, and making more strategic decisions within the organization. So you can see that management accounts, or managerial accounting as we like to call it, is more focused on decision making. It's for internal uses, for decision making within the organization. And there are some major tools that are utilized in management accounting, and they include: one, budgeting and forecasting. I'm sure a lot of us are knowledgeable about budgeting and forecasting. So, budgeting and forecasting, this has to do with looking into the future. It's like predictions, it's creation of a structured, quantitative plan for the future. So, we are predicting, oh, the cost of rice is going to be so amount at this particular period of time. So, now we do not know the actual amount, but it's based on assumption. And we have variance analysis. Now, variance analysis means to compare the actual amount and the projected amount. Projected cost is also known as standard cost. So now, when we talk of variance analysis, we are talking about comparing the actual amount spent, or the actual cost spent, and the budgeted cost. Okay, now, if now we're in 2025, right? If now we are predicting that the cost of rice is going to be 1,000 naira in 2026, and then in 2026 is actually 900 naira. So the comparison between the budgeted amount of 1,000 naira and the actual amount of 900 naira, that is what we call variance analysis. Number three, variable costing. This focuses on variable costs for decision making and profit calculation. So now, what are variable costs? Variable costs are costs that change in proportion to the quantity of goods or services an entity produces. Let's say for instance, now we're a bread making factory. If we use 10 bags of flour, the price is going to vary from when we actually use a single bag of flour to produce bread, right? So now that is a variable cost because it is changing. It's not stagnant. It's not always going to be the same. So those are the three major tools we'll be discussing in this class. So now I would like to draw out the major difference between all three branches of accounting. So let's begin. One, financial accounting. Financial accounting is more focused on the external users of financial information. Cost accounting is more focused on internal use by the organization, how they can use their current expenses to plan for the future and make more informed decisions. So it's a tool used by management for decision making. So it's more internal. It's more for internal use. Number three, management account. As the name already implies, we know it's for management, it's for decision making. So it's more focused on internal. We're a bread making factory. If we use 10 bags of flour, the price is going to vary from when we actually use a single bag of flour to produce bread, right? So now that is a variable cost because it is changing. It's not stagnant. It's not always going.